Hello everyone, welcome to the 6th class of interview current affairs. Today we are going to discuss a changing trend in India's foreign exchange reserve. If you consider India's forex reserve trend, it has been booming since last 3 years. From 2019 to 21, it has been consistently increasing. On the other hand, in 2022, it registered a fall of $70 billion. So what exactly prompted this reversal of trend? That is what we are going to discuss in today's class. Myself Vivek, welcome you all. Let's get started. So it's not just about forex reserve. Whatever the geopolitical happening that is happening today, whether it is the fall of Indian rupee compared to that of dollar, or whether that is the fear of economic slowdown in the advanced world, everything is one way or other related to two major happenings. The first one is the aftermath of pandemic. So what happened during pandemic? You all know there were very stringent lockdowns that is imposed throughout the world. What are the implications it had on government? Due to the lockdowns, the GDP were slashed out and government was severely losing revenues. Government revenues were considerably falling. At the same time, government expenditure were considerably increased. Why? There was increased expenditure on healthcare. There was increased expenditure on vaccines. If you can remember or recall it, what happened in India, there was spread of food grains were supplied during the pandemic. So everything is one way. Government expenditure has shoot up. US market, people has given free money for unemployment during pandemic. So what is the implications of this? The world was moving through a phase of unsustainable levels of fiscal deficit. When what central banks were doing? Central banks throughout the world were taking a stance that is very supportive of the government. That is, they were slashing the repo rate to support government initiatives that is happening, to have a scope for government to borrow at a much lower rate or to maintain the money supply in the economy. Central banks throughout the world, in India also you can see repo rates falling below 3.5% and all. And in US also the repo rate has been slashed dramatically. Now this was all happened during pandemic, that is during 2020-21 phase. Now it's early 2023. The fears of pandemic that much that have were in 2 years back, today that is not there. So what is the implications? One way or the other, the world is going back, or the reversal of what are the policies that being imposed during the pandemic. The governments, like advanced governments especially, are cutting down the extra spending to maintain the fiscal deficit in a sustainable margin. What are the implications of this? Government spending, that is a major contributor to the GDP of in the country, if that is being slashed down by a huge margin, it will definitely have its implications on GDP. That is one way or the other prompting the fear of economic slowdown in the advanced world. And what is central banks are doing? The highly reduced repo rates, they are slightly increasing. You can see last two terms, Indian repo rates has been increased. The same thing is happening with US Fed. US Fed is increasing its rate. Now once US Fed is increasing its rate, how it is going to impact emerging country or emerging markets like India? From an investor perspective, even though US market may be delivering a lesser interest rate compared to emerging market like India, it's still much preferable. US market is still much preferable for investor perspective. Why? Because the huge level of trust factor, because of the huge level of sustainability that is associated with the US market. Now if US market is itself having a huge trust factor and it's itself giving a higher interest rate, what is its implications? Investors are going to take out money from emerging countries and invest in US Fed. That is exactly what is happening nowadays. The other thing, to add more fuel to the uncertainty, we had the Ukraine crisis. In the last class we have described how Ukraine crisis is forcing other countries to come in line with Russia, weaponization of energy policy by Russia. All these things we discussed. Now if you look at the economic implications of it, that is much more. On one side it is adding more uncertainty. Second line, crude oil prices, that is on rise. Supply chains of even agriculture products like wheat are all disrupted due to the Ukraine crisis. Now, in a moment of uncertainty, if investor perspective, there is high risk associated with emerging markets. And from India, if you look, around 1.2 lakh crore rupees has been taken out from Indian equity market by foreign investors and taken back to the advanced countries. So it is in these two factors, these two dynamics, you have to analyze everything that is happening in the geopolitical world today. Now let's go into what is happening with Forex reserves. You can boil down to two major reasons why India's Forex reserves are falling. The first one is valuation loss. How Forex reserves are kept? Forex reserves are kept as US dollars, mainly a foreign currency. There will be other currencies also, like euro, pound, IMF's SDR, everything which is based on 5 different currencies, including China's currency. And there will be some gold, and there will be some UK or US majorly based bonds. So if you take out the gold, what is happening to the other factors? Indian rupee has been falling compared to rate, compared to US dollar. There has been considerable appreciation of US dollar in the last 1 year. From a level of 74 rupees, it has fallen to 83, 84. Now it is being 80, 81, 82 around in today's times. So dollar is losing value, and most of the Forex reserves is kept in dollars. India has to fund more money to get the same dollars. So one way or the other, whatever fund we are keeping, that is losing the value. Secondly, other currencies are also part of India's Forex reserve. And it's not just rupee is depreciating. All other countries throughout the world is one way or the other undergoing the same trend and depreciating. So that is also contributing to the loss of valuation of the Forex reserves. Finally, UK and US bonds. India has to fetch out more money to have these UK and US bonds, and the yield has been considerably high. That means the earlier bonds are making losses maybe in present times. So all these contribution lead to valuation loss. Experts say that 55 to 60% of India's Forex fall in 2022 is one way or other related to the valuation loss factor only. This other factor, we have seen that the investors have taken around 1.2 lakh crore money out of Indian market. When this much money is gone, how they take out this rupee? They convert it into dollars and they take out the dollar. This much of worth dollar is going away from Indian market. There is going to be huge demand for dollar. And this demand for dollar is leading to depreciation of rupee. Now, if depreciation of rupee is totally left uncontrolled, it may lead to huge economic and fiscal implications. To check that, how RBI intervenes. RBI sell dollars in the Indian spot market. If you look at the last 2022, RBI net sold around 54 billion US dollars in the Indian market. So RBI is selling more dollars. Where this dollar is coming? It is also being taken from India's Forex reserves. So at the one side, we are losing the value of whatever Forex reserve we are holding. On the other hand, RBI is utilizing the Forex reserve to check the fluctuation of Indian rupee against dollar. So both these factors has led to considerable fall in India's Forex reserves in 2022. Being said, let's go ahead. Forex reserves is very much important for India. From words of IMF, Forex reserves reduces the likelihood of having another BOP crisis, which is totally unheard in India from 1991 crisis. Secondly, it gives enormous economic and financial stability. This is very much important considering the fact that 85% of crude oil in India is imported from other countries. And crude oil prices, you have now seen enormous variations in price levels. And it gives scope for high level of policy autonomy, which is very much in line with the idea of strategic economy upheld by India. Today's India's export cover using the Forex reserves cover for around 9 months. This was 13 months a year back. So one way or the other, India had to have a stronger forex reserves. That's all for today. Whatever understanding, whatever concept we have discussed, answer these questions. Why India's forex reserves is falling in the recent past? What are its implications on India's national interest and economy? Why rupee is falling against dollar? Comment the answer, your opinions and answers. That's all for today. Thank you.